Wondering what's happening with the economy? An expert provides some answers. This is the Issues Watch podcast. Hi, I'm Jeff Kazerman, Vice President of Government Relations at the New Jersey Society of CPAs, and welcome to the Issues Watch podcast. Everyone is wondering where the economy is headed. We've got very high inflation, a Federal Reserve trying to cool things down with sharp interest rate hikes, a significant drop in the number of jobs available, and a stock market in a tailspin. So are we looking at a recession coming? How bad might it be? Maybe we're already in a recession. Today, we're going to talk with Roosevelt Bowman, a senior investment strategist with Alliance Bernstein's Wealth Strategies Group. He was also a research analyst at the Federal Reserve Bank of New York. So I think he's a perfect person to talk with about how the economy is faring right now and where it might be headed. Welcome, Roosevelt. Thanks for being here with us today.
Thank you, Jeff. I appreciate it.
In a recent KPMG survey of 400 leaders of large US companies, 91% predicted a recession in the next 12 months, and 65% of them don't think it's going to be mild and short. In your view, what are the short-term and longer-term prospects for the economy?
Yeah, sure. And again, thank you for having me. I think in terms of recession and the definition, that does slide a bit. Usually people use the definition of 2 negative quarters. That's actually some shorthand and not really what it is. We really think about a protracted decline in growth, whether you term it a recession or not. We are anticipating that. We think monetary policy will be effective in bringing down inflation. Unfortunately, the cost of that is much slower economic growth in the US, both in 2022 and 2023. So I think that's over the short term, we unfortunately have to take some pain to alleviate some of these inflationary pressures. It's really the demand side that the Federal Reserve can impact my old employers, not the supply side in terms of COVID and the supply chain issues, which are improving. But I think over the long term, we're thinking about a growth rate in the US somewhere in between that 2.5%. The main reason for that being is just a shrinking labor force in terms of because of legislation, but also because of demographics. People are not having as many children. We're just not replenishing the working age population as quickly as we should.
What are your thoughts on the high inflation we're seeing? Do you think the Federal Reserve has overreacted with its steep interest rate hikes? Will inflation come down? If so, when? How long would it take?
Sure, absolutely. I mean, I think that the Federal Reserve, and as I mentioned, I was a research analyst at the New York Fed. I think they were late in recognizing the inflationary pressures, and now they did have to play catch up. That's the reason for the speed and size of these rate hikes. I think it's the right thing to do. When you look at how elevated inflation has been and how persistent it's been across different categories, it really only points to one direction of action for the Fed. So I do think they were late. I think they're right to move as aggressively as they are. I will say this in terms of the outlook going forward and when we think inflation will come off the boil. When I look at the numbers over the short term, and some of my colleagues that now work at the Cleveland Fed have done a terrific job of forecasting inflation, still looking for it to be pretty elevated through the end of this year. But I think as the turn of 2023 comes, then we should start to see some of those pressures alleviate. I'll also say that, look, where we are from a Fed funds standpoint and what's priced into stocks and bonds in the market, it's a federal funds rate of almost 5%. If I'm right about long-term growth and it's only 2.5, that spread between the federal funds rate and US GDP being about 3%, that covers about 2/3 of the time in history over the past 50 years. So basically, when you look back 5 decades, that difference between Fed funds and GDP is either 3% or lower. So I think it will be tough for the Fed to kind of push and for interest rate expectations to be much above 5%. But I do think there's still a little bit more room to go, given that inflationary pressures have proved to be persistent.
Okay, so when do you think like the average consumer, an individual consumer, might see significant price declines? And I realize it could be happen slowly. Like, when are things going to get back to normal?
Yeah.
Like, are we talking like 4 or 5 years, 2 years? What? And I know, you don't
Yeah.
have a crystal ball.
No, I do think it's more of the two rather than 4 or 5. When I think about some of the, we think about what's driving the prices higher, it's really been the demand story and the supply story. Demand story meaning tons of stimulus from the government and the Federal
Right.
Reserve, and then the supply chain issues and COVID on the supply side. All of those pressures are starting to dissipate, but just very slowly. So supply chains, we have our own indicator at Bernstein, kind of measuring those supply chain stresses, if you will, and it is improving. Some of the COVID is the kind of zero COVID policy by China. There's some talk about that maybe being taken away. So I do think the supply pressures are receding somewhat, and then the demand side should come down with the Federal Reserve continuing to hike. I do think it's more of a 2 to 3 year thing rather than a 4 to 5. We're already starting to
Good.
see some of that in food and energy commodities.
So the Labor Department reported that job openings fell by 1.1 million in August, which is the most in almost 2.5 years. What does that tell us?
Yeah, I mean, it really tells us that some of that economic slowing that I was alluding to is starting to happen, that there's lower demand for labor. And even when we look at some of the high frequency information, so online job listings, those have come down sharply. They're probably at their lowest level in 12, 13 months, and they're down about 25, 30% over the past 3 months. So firms are starting to pull back in terms of their hiring intentions. It is a bit different across industries, right? It's not the everybody coming down at once. It's a little bit lumpy, but I do think some of that demand for labor is coming down. I think the reason that we haven't seen wages come down as much is that COVID is still disruptive. Even if we're having in-person events and we're kind of all going with their life, when you look at survey data from the last couple of months, it still shows that people, some portion of the labor force is not necessarily re-entering because they're either worried about being sick or they have logistic issues with childcare. And so,
Yes.
to the extent that COVID is still disrupting, that's keeping some people out. So even if you have fewer jobs, you still have a smaller pool of labor. And that means the wages are take a little bit longer to come down. And wages are important because more money in the pocket, more people can buy goods and services, inflationary pressures remain high. The Fed, and almost, it seems like an odd thing to root for, but the Fed's trying to push down that demand for both consumers and businesses so that they hire fewer people, wages come down, demand for goods and services come down, the prices come down as well.
I assume also some people have just permanently dropped out of the labor market. And I say that, based on a lot of companies who were fully, had all the employees they needed before COVID are now, and I think this includes sectors in the CPA profession, can't find people.
Yep.
And, I don't know if that's because some people stopped working, they had other income coming in and they were like, you know what, I'd rather, I'd rather take it easy than work so hard or work 2 jobs. Is there anything to that, what I'm thinking there?
There is. So it's interesting. I think I'll separate a bit by age. So what's interesting is if you go 55 and above kind of workers, that's where you've had a lot of people exit and say, I was going to retire 3 or 4 years from now. Especially some of the gains, even with this year's losses, you still had robust gains in 19,
Right.
20, 21. And if they maybe control the spending a bit, they're fine. So you have some of those people, have people just not wanting to get sick, retiring early. So that population has really kind of accelerated their leaving of the workforce. The 25 to 54, that kind of base working age, that participation is back to where it was pre-COVID levels. I think some of the shortages for industries is that people have moved up and around. So some of the folks that maybe moved out that were older, someone who was younger can now move from one firm to another. And then you have that competition for talent. But then also
Right.
some folks, and this is more, I think, in the retail, less in kind of our businesses, professional services, but I think the professional services is more than moving around within the industry, moving from one firm to another, because maybe there's a spot opened up, you get better compensation, better career path. I think in some of the other retail industries, you're having people move out and not go back. So I do a lot of career mentoring, and I also program. And I do some statistical tutoring, and I've noticed a lot of people who were in retail, they're taking some courses, they're moving out, they're learning a program, they're making 5 times what they made before. They don't have to get COVID. They're gone. They're never coming back to go work
Right.
at a fast casual or retail or a mall. So I do think it's a combination effect of the older cohort leaving, movement intra-industry for talented workers in professional services, and then some people at retail finding much better options outside of their previous industry because they were able to stay home, train for very low or
Oh,
zero cost during COVID, getting that subsidy. They're able to sit home, stay safe, train, and now they're never going back to their old job.
yeah. Okay. Well, that's, I got part of it right then. Okay. I'll
Yeah,
take that.
absolutely.
So the economy, from at least as far as I can tell, and again, I'm not an economist, uh, it it survived, more than survived, I guess, much better than I expected. And there was the market boom until whatever, half a year ago. So do you think everything looked fine and good, and much to my surprise, we were doing very well getting through COVID. Now, obviously, we're not. So do
Mhm.
you think the pandemic, particularly, what was going on at its height in 2020 and 2021, has that played a role in the worsening of the economy this year? In other words, has that led to a situation where, like, yes, the economy did well the first year or two of COVID, but now we're paying for COVID?
It's a really good question, Jeff. I don't really think so. I think more the issue is that I do think there's still some lasting impacts from COVID, right? That have, maybe taken some people out of the workforce, like we talked about before. I think the issue is more that there was such a strong response from the Federal Reserve and the government that kind of bought time until we had some health solutions to get people and reopen again. And now, in some ways, we're paying the bill for very low interest rates and robust economic activity and really high stock prices. Federal Reserve said, oh, wow, we're late to the party here. We need to catch up and we need to raise interest rates sharply. And that really has been the story of the economy and financial markets. It's just a really sharp rise in interest rates because it really does two things. One, you're changing the valuation of both stocks and bonds at the same time. Bonds simply, as interest rates go up, prices go down to
Right.
entice people back into those bonds. And then for stocks, it's the same thing. It's all about your choice. If interest rates are zero, us as investors, we're happy to go and take some risk in a stock that will likely return much more than that. If safe interest rates are 3-4%, all of a sudden my stocks need to have a lower price if they're earning the same for me to be enticed to take that risk. So I think that's really the issue. The other thing too that's kind of creative volatility this year, hurt financial markets, is that there's been great uncertainty around how far and how fast interest rates are going to move, something we haven't seen for the last 10, 12 years. For the most part, the Federal Reserve has either been easing a lot or easing a little over the past 12 to 13 years, even kind of through the pandemic. Now we're in a situation where the Federal Reserve is tightening and you don't know where the end point is. A lot of investors said, wow, interest rates were 1.5. Now they're 2.5, maybe they're 3.5. I don't know how high they're going to go. I'm going to be out of these assets. Let me sell my stocks. Let me sell my bonds. Not the best thing to do long term, but certainly that's been
Right.
part of the reaction and part of the price pressure on both asset classes.
Right. Were you surprised at all by the quick, excuse me, the quick, how the economy, straightened up and straightened out and did so well, shortly after COVID began? Was that a surprise to you, or do you know stuff I don't, which you probably do, so
Well,
that it wasn't a surprise?
I think what's interesting, it wasn't as much of a surprise only once I saw the degree of support from the government and the Federal Reserve. And I think that because they were acting in a way that was very different than 2008. 2008, there was lots of, and I was working at the Fed shortly after the crisis, there was lots of kind of discovery. There were new tools. The government was slow to provide support. I think that episode really motivated policymakers to say, hey, we need to provide support to the economy by time until there's kind of improvements and medical solutions to get us all back on our feet. But it was a kind of interesting recovery that was really focused only on, in the beginning, on technology and technology enabling all of us to work together. And then the recovery sort of broadened out into the in-person categories at the end of the year, once it was clear these vaccines were available and effective. So I think that's what was interesting about it, was that it wasn't a complete recovery instantly. It kind of happened in phases. But I think that once I saw the will for policymakers to support the economy, then you could see, okay, this is going to be work out better than maybe we originally anticipated.
Right. So, talking about all that aid and stimulus money, that obviously costs something, and it costs the federal government trillions of dollars in debt. I have my figures right. Debt went from about 22 trillion in 2019, right before COVID, to about 31 trillion right now. So how harmful is this for the short and longer term economic outlook? I mean, it seems like in the old days, deficits, and debt is all they spoke about in Washington, but I really haven't heard much.
Yeah. I mean, Jeff, you're right. Washington follows the voter interest. And so I looked at this before the pandemic. The debt was maybe 7th on a list of issues for voters, both Democrats and Republicans, right? So mixed group, even sample, and it came in 7th. And this is before the pandemic. I think it's down to something like 10th or 11th right now. So wow. I think over the short term, the threat is not that high, but I wouldn't say it's for a good reason. It's a little bit of do as I say, not as I do. When you look at the difference in the UK, they put forth a big spending package and the market absolutely punished them with their bond prices going lower and their currency. The US being, and the US dollar in particular, being the world's reserve currency, we're able to borrow much more than we quote unquote should, given those kind of alarming debt to GDP metrics that you just talked about, right? The fact that we're borrowing much more, our economy size is probably 21 trillion, and we're borrowing much more than that. So because we are the world's reserve currency and 88% of all foreign exchange transactions involve the dollar, that foreign exchange market is 6 trillion a day. We're just a behemoth. There isn't a good substitute. People have been writing articles and books about the dollar losing its dominance for a while. I think that's in the future, and I don't think there's a single good replacement for it. So we're able to borrow a lot more and kind of quote unquote abuse that right to keep borrowing. I think the long-term problem is less one of credit quality and more of growth. If you think about it, we keep borrowing money, the tax revenue we pull in, it's like being in a treadmill. You're just running but not going anywhere. And we can't take the money to apply to endeavors that have higher return on investment. It's just, we're just using the money that we collect from, as tax revenue to pay off our debt, which, is again, part of that longer term thesis of why maybe we're a country that doesn't grow a whole lot above 2.5%. We're just not applying that revenues that we're taking into better projects.
Right. So in other words, it's being borrowed by the government instead of being borrowed by businesses. Yep. Just okay. That was like my economics 102 macro. Right. So as you probably know, New Jersey is very reliant on tax revenues that are generated by residents who work on Wall Street or who invest in the markets. So how do you expect, so therefore it's kind of important as far as New Jersey state government, how do you expect the markets will do over the next 2 years?
Yeah, so it's interesting. I think, over the short term, let's say 3 to 4 months, we're still going to be in a volatile period because I think inflation's still elevated. And for the Fed to take their foot off the gas pedal, they're looking for downward momentum in price pressure. So it can't be 1 month. It has to be multiple months in a row, probably 3. They haven't laid out the exact time frame, but let's call it 3. So each time you have a print like today and it comes in hotter than expected, you're pushing out that Fed pivot to easier policy another 3-4 months. So I do think we're still in this volatile environment where it's difficult for stocks to have a durable recovery until 2023, first quarter at the earliest. However, I do think when you think about where we are in Jersey and the tax revenue and those workers, it's a little bit more mixed than positive. The reason I say that is a lot of financial institutions, it depends on your business line, right? If you are in mortgages, maybe, yes, housing activities slow down, but you're getting a much higher level of interest. If you're in asset management, not so great. Obviously, assets are going down because prices are going down. If you're on a trading desk, my people that I used to trade with and my old friends, you're having a really good year because maybe the firm overall and financial stock prices are going to move just like typical S&P 500. They're very well correlated. So maybe your stock price is down as a financial firm, But those traders have had great years because it's been volatile, and they're making money when markets are volatile, not necessarily in terms of the direction of the market. So I do think those workers that are like myself, that are going back and forth from New York to New Jersey, it is a bit more mixed and positive because it's not all directional with the market. Certainly the underlying stock exposure, those that are paid someone in stock, no doubt about it, that's going to take a hit. And I don't want to say like it's a banner year for Wall Street overall, but I do think there's still enough of a spread in real estate prices between New Jersey homes and those Manhattan apartments that, it's still appealing for those that want to stay there. So I don't think it's going to impact New Jersey as much as maybe much sharper downturn.
Okay, so compared to other states in the Mid-Atlantic region, how is New Jersey faring? Now, I know we are or were lagging the country as a whole in several factors, but I think the important measure is really how we're doing compared to New York, Pennsylvania, Connecticut, and maybe Massachusetts and one or two others. How are we doing compared to them economically?
Yeah, interesting enough. So growth wise, kind of looking at the second quarter data, the most up to date, growth wise, New Jersey's kind of in the middle, above Connecticut, kind of right on par with Pennsylvania, a little bit below New York and Delaware. So, fairly competitive, all with, I would say, low growth numbers for second quarter. No surprise there, given the tighter policy and the general slowing that we've seen and we expect to see more of in the economy. Interestingly enough, income levels, and this speaks to what we were talking about just previously, income levels for New Jersey, that growth in second quarter pretty strong. Really on New York, only New York was outpacing New Jersey, and New Jersey had a decent spread over Pennsylvania, bigger over Connecticut and Delaware as well. So New Jersey is hanging in there. And I think something also that's interesting in showing that demand for living in New Jersey is that if you look at home prices in New Jersey, typically they would be they'd be positively correlated with being closer to the city, right? So closer you are to the city, higher price.
Right.
That actually has flipped. The higher prices now for some places are places that are further out, and that's because of the work from home phenomenon, right? And I've done and read a lot of research on this. Before the pandemic, you were looking at less than half a day as your average kind of expected work from home. Now it's up to 1.5, maybe even 1.75, right? So people are saying, hey, if I'm only commuting to the city 3 times a week, maybe for some people too, I want more space. I want more yard. I want a different pace of life for, what ends up being 55, 50, almost 60% of the time. Sometimes when you include the weekend, they want that different pace of life. And so that I do think is going to keep some of those real estate prices fairly firm. Without a doubt, we're going to go down like the rest of the nation as interest rates go up and people just don't want to borrow. But I do think the declines are likely to be less.
Right. I think also, especially in the beginning, a lot of people in New York City, they were scared from a health perspective, being so close to so many people and crowded in that they came out. I mean, I actually know a real estate agent, a very good friend of mine out in Sparta, New Jersey, which is, for New Jersey, it's like the countryside. And she said business was booming. People were petrified, who lived in New York City or even Hudson County, and they were moving out to Sparta.
Yeah.
Okay, I have one last question for you, I promise. And I think I know the answer based on some of what you just said, but what are economists in general saying from an economic perspective, that is, about how the federal government responded to the COVID pandemic? Did the government do a good job, bad job? What are you hearing?
I think in terms of I think most economists would say that the government did a good job in terms of providing stimulus to get the recovery going, and that was much better than 2008, like we discussed, where it took a long time to get stimulus packages out, and that led to a much slower and protracted recovery. I think most economists, their criticism is more towards the Federal Reserve in terms of being late to recognize the inflation problem. Completely understandable, fair criticism. I think the reason for them being late wasn't so much because a lot of what people have criticized, which is an assumed bias towards easier policy, but more that this was an exogenous problem that was completely outside of the economy, and the Fed didn't want to tighten too soon choke off the recovery for something, a
Right.
problem they didn't have to deal with. So I do think, and I'm not apologizing to them because I work there, but I do think hindsight's a bit 2020 when it's easy to sit here now where it seems like the new proliferation of variants has slowed down and we're in a much better place. But at the time, you're dealing with a really global health crisis, and to tighten too quickly in royal markets, I think, was what their concern was. There's no doubt about it; they were late, and I think that's where economists have criticized more the Federal Reserve rather than the federal government.
Right. Well, everything you just said there, federal government's response, I agree with that. So that's what I've been thinking. So I'm getting better at this economic stuff. Maybe I should have stuck with that as a major. Anyway, this has been a fascinating discussion. And thank you so much for joining us today, Roosevelt.
Absolutely, Jeff. Thank you for having me. I appreciate it. I can't wait to do it again.
Thanks for listening and watching. For more information about the services provided by Alliance Bernstein, visit alliancebernstein.com or follow them on Twitter at AB_insights. And be sure to support the New Jersey CPA Political Action Committee, the only nonpartisan group in New Jersey dedicated solely to fighting for CPAs in the legislative arena. Learn more and contribute at njcpa.org/PAC.